are here with Danny Flores. Danny is the owner of Prime Capital Investments, a real estate acquisition firm specializing in multifamily properties. His company focuses on identifying undervalued, mismanaged assets that have not kept up with market rents, targeting locations with strong population and job growth, such as California, Arizona, Texas, Florida, Louisiana, and North Carolina. Under Danny's leadership, Prime Capital Investments has delivered strong returns to its investors with a focus on strategic value-add opportunities. Without further ado, welcome to the show, Danny.
Hey, thanks, Eric. Thanks so much for having me on the show. Happy to be here.
Okay, well, we're happy to have you as well. To hear that we've got tons and tons in common. You're a former tradesperson. I'm still a tradesperson. And also to hear that you were a carpenter, it's really impressive and really inspirational for me to see that you came such a long way to being a successful syndicator, commercial real estate investor, to have humble beginnings as a tradesperson. So I love to unpack some of that a little bit further in the show. But for now, if you could share just a little bit more about yourself and also how you got started in real estate, that'd be great.
Yeah, no, thanks so much. Yes, so it's kind of cool that we both I was union carpenters, but that was actually my first career. When I was younger, I was a general contractor. When I was 21, was in the residential side of the business. Then I went into heavy construction. That's when I got into the union. Then during that time, I decided that I wanted to basically retire out. I wanted to do a career change. I ended up lucky enough to get into USC, got a corporate finance degree from there. My goal was to become a banker. Went to school, worked at the same time because I had to pay for school. When I graduated, retired out of the union carpenters and became a banker. When I was in multifamily deal, which was always my dream, is to buy multifamily deals. I saved $65,000, bought a fourplex here in California. Then about a year and a half after, I sold that fourplex and made $100,000 profit. So now I had $165,000. I had saved some other money and did a 1031 exchange. And for the next 15 years, using my own money, did exchanges, buying more buildings, buying bigger buildings. But in 2018, a friend of mine saw what I was doing, and he goes, why don't you syndicate? I'm like, well, what does that mean? I didn't really understand what he was saying. He said that his mom and dad invested with a syndicator up in West LA. They did a lot of projects. His parents had bought a handful of houses up in the West LA area. And I said, okay, I'm sold. I need to learn how to do this. In 2018, I hired a coach that basically taught me how to syndicate. I knew how to do the deals. I also had created a property management company in 2006, which I sold about 4 years ago. But as I was coached and I learned how to help investors increase their wealth by investing in the projects that we do, I was able to raise money to do bigger deals. And so what I did is I applied my building skills, my financing skills, my property management skills in buying these projects and managing them. And it's gone really well for our investors. And so we like what we do. We do it pretty well, and we just want to keep doing it and growing and getting bigger.
Yeah, that's great information. And you've got an amazing background to come from being a carpenter all the way up to becoming a banker and then becoming a full-time syndicator as of today. That's really an accomplishment. And it just really is a testament to your work ethic to be able to set a goal and then actually go after it and achieve it. So you mentioned that you had a property management company. Do you feel like every syndicator should go after vertically integrating, or is that something that should come like down the road or down the line? Should a person start with third-party property management, you think?
See, that's a good question. And I've always asked myself, the ones that do that, why do they do it? The ones that don't, why don't they do it? Right now, we don't do that just because I know, I don't want to say a headache, but it is a lot of work to manage your properties on your own. I've talked to different operators that do it. Some have said because they can control the outcome. We can control the outcome with the companies that we work with. So that's like a moot point. Others say they can control costs. I've seen operators that do it well, and I've seen operators that don't do it as well. So basically, when you're running this business, when you're running these deals, you have to assess yourself and your team. Are you doing a good job? Are you providing the returns that you need to provide to your investors? And are you hitting your business plan on your asset? If going vertical gets you there, then do it. If it's a struggle for you, then maybe you shouldn't do it. And I think that's basically on a case-by-case basis.
Yeah, I agree with you. I think every person and every company is going to be really unique as to if they want to vertically integrate and if it's going to be a really good fit for them. And so I've talked to people on both sides of the aisle when it comes to that. And it's a difference of opinion and a difference of what works best for each person. So that's good that you're able to identify that. If I could, I'd like to just go back a little bit. There's a lot of people within my audience, they have W-2 income or either they have a business. And so I always try to provide them with some sort of value as to how people actually got their business off the ground, how people were able to successfully buy real estate while working full-time jobs and full-time hours. If you could allow us to peek in on that, what exactly was working for you when you were trying to get the business off the ground, when you were trying to accumulate a portfolio, and what were some things that weren't?
Yeah, so no, that's a great question. And those were interesting times, right? When you're trying to make the transition from your W-2 to a side hustle. And it doesn't matter what it is. It could be an e-commerce store. It could be, investing in real estate, a syndication group. But at the end of the day, the way I did it was I knew that I had to work two jobs before I can quit one. And what I mean by that is in the evenings, on the weekends, and maybe even sneaking a phone call every now and then during the day in doing the acquisitions that I was doing. Right. And, you want to save some money for a rainy day. If you're married and there's two partners, it's easier. What you have to do is you have to cut your expenses to be able to live on one partner's salary. And I mean, just cut everything, car payments, eating out. You have to make the sacrifice or you'll never get there. So when you're building your side hustle, you have to start building it, and you end up working two jobs. Whatever you're trying to do, if you're in the apartment business, you got to start buying, you got to start building, you got to start working, and it's going to get real hard before it gets easier. And if you're able to build the business big enough simultaneously, then that's when you can basically pull that parachute and jump ship. But it's planning. So you got to plan it. You got to cut expenses. You got to run super lean to be able to make that transition. And then once you make the transition, you should have the extra time to help your business and propel it to grow. Because now you don't have your W-2 job, right? You make it, and now you're growing that, and now you're able to maybe breathe a little, maybe get more comfortable, make a little bit of extra money, and kind of relax a little bit. But it's tough. No matter what, it's going to be tough for anybody you try to do that, but you just have to pay your dues, basically.
Yeah, it sounds as if you just had to have the right mentality and view things from the proper perspective, because it's easy to get frustrated or sometimes even overwhelmed, because I still have W-2 to this very day. And I just don't have the freedom that I would love to have to be able to apply to my business full time. But I do have the mentality. I do realize that I'm basically working two jobs, just as you said. And so I know it's going to be a bit of a grind. So I love what you shared and all those details that you gave. So if we can fast forward to today, what exactly do you guys do within your business as of today? I know that you're buying real estate, you're syndicating real estate in multiple states. What does your business look like, and what has it looked like within these volatile interest rates?
Well, basically, what it looks like is I have team members on staff that help us find deals. So, full time deal sourcer. So, it's a constant thing, right? You have to continually underwrite deals. We have our support staff. And so we track the performance of our deals. Probably we touch our deals at least twice a week. Monday mornings, I have one of my admins that they send us reports on all the deals. We want rent rolls, we want delinquencies, we want to know where our deals are at. And then on Thursdays, we actually have calls and meetings with all our management teams from all our deals to get basically a full report. So one is maintaining what we have. The other part of it is looking for more deals. Now you mentioned that we're in a high interest rate environment, which has started to come down. That makes it more difficult to buy deals. We see some groups that step back and say we got pencils down, and they've been pencils down for the last year to 2 years. During this time, we've looked at it a little bit different. We've looked at it as this is the opportunity to when the new housing supply gets reduced in 2026-ish is what we're targeting. Then we're going to start having rents increase again. So reduction in interest rates lowers the cap rates, increase in rents increases the revenue, NOI, and puts us in a really good position to do really well for our investors. So we keep buying, but maybe it's not always with new money. Maybe it's owner financing. Maybe it's assumptions. So you got to get a little creative to kind of circumvent the higher interest rates.
Yeah, I feel as if you were able to weather that storm or weather some of those downturns is probably going to make you a better investor, because if you're able to make money in tough times, when things come back around and the grass gets a little greener, is probably going to put you in a much better situation, and you don't necessarily have to get so creative. But there's been a lot of different people that have been looking for those assumable loans, creative financing in order to justify pulling the trigger on some of these properties. So, hey, Danny, if you could share with us a recent transaction that you've closed lately. If you could just share some high-level details, how you located it, how you funded it, some really interesting things that took place within the property at the closing, or if you exit the property.
Yeah, so we bought earlier this year. Most of the deals that we buy are off market. And that's because we have good broker relationships. We get that phone call and they ask us if you want this deal, tell us what the owner wants. If it makes sense for us, we'll buy it. So we ended up buying, we were very active in Arizona. So it was a deal in Tucson, came to us off market, smaller deal. That one was only 38 units. It was fully renovated. Gentleman basically said, I can't do both. I had to take care of my wife. I got to sell my deal in my building. And that's when we got the call. We looked at it. It had agency financing on it. So we did an assumption on the loan. Loan was 3.45%, good for the next 7 years. So it doesn't mature till 2030. So that puts us in a really safe zone to be able to do that. The issue that he was having, because we like to do value add deals, was that his operations weren't correct, weren't running well. His management company wasn't doing a good job. The rents in the units were about 150 under market, and they were operating the payroll as if it was a 100-unit building. And what that means is that we liked the deal. We knew what we could fix. We were going to change the management companies. And so we closed the deal, changed management company, reduced payroll, reduced operating expenses, and started leasing all the units at market. and renewing leases. So our revenue keeps increasing. Operating expenses came down to basically what we forecasted, and we're just making this building operate like the way we want it and the way it should.
Okay. And so you guys didn't have to do any renovations to the units because the value add as far as the renovations to the units had already been made, but you were coming in and cleaning things up as far as financially, lowering the expenses, driving the income, and also putting better property management in there. So, what was the strategy to be able to get a better property management company? Because it is a lower unit count. What did you guys go about doing for that?
Yes, that's a good question. We have multiple management companies that we work with in Arizona. We have larger buildings where we have 100 plus units, 80 plus units, we have one management company that manages those buildings. If we have smaller buildings under 50, 60, 40, 30 some units, we're going to use a different management company. They operate differently. So depending on the size of the building, determines who's going to manage it, because we have to be cost effective with the management company and the payroll and all those fees that management companies charge. And so we are very well versed and comfortable operating that area.
Okay. And so 38 units, what do they normally charge? What does property management companies normally charge for those smaller assets like that? I know you guys already had a footprint there. You already had existing properties that you could have somewhat economies of scale with. But let's just say this was a one-off deal in a new market. What do you guys look to pay for property management?
Well, if it's a one-off deal in a new market, it depends on the market, right? But let's just say potentially that you expect to pay maybe like an 8% management fee on a smaller building like that. Now, the fee sounds a lot because on larger buildings we only pay 3%, but it's staffed. The larger buildings are staffed, and that's why the percentage is very low. But we're paying full-time employees in those buildings. In these smaller ones, you don't pay for the employees. You don't have employees there. It's basically site visits on a case by case, whether they're doing pool inspections, property inspections, or even showing vacant units to potential renters. So that's why you pay a higher percentage, and that's the way expect the price difference between large and small.
Okay, and how long do you guys typically hold your properties? Is it the traditional 3 to 5 years, or do you guys hold on to things a little bit longer?
Yeah, no, we average about 5 year hold is what we project, and we're shooting for like no less than a 15% IRR return for our investors, and that translates to like basically 2x equity multiple. So if somebody puts money into the deal, we want to be able to give you twice as much back within a 5 year period. We have basically our track record has been less than that. So we've been able to hit these numbers between 2 to 2.5 years. Equity multiple in a 2.5 year period, the return percentage really jumps. Now we can't guarantee we can keep doing that. We didn't sell anything last year. We didn't sell anything this year, just because the interest rates are so high, and we don't know what's going to happen next year. But nevertheless, we want to be conservative. We want to be able to say, okay, we predict that we'll be able to exit in about a 5 year period, and it depends what the market gives you. If it gives you the opportunity sooner, we take it. And you also have to remember it could also actually be a little bit longer too. So it can go either way, depending on where the interest rates are and where the markets are too.
Okay, and so when you guys are looking at debt, are you guys always going after the longest debt term that you can go after, or is each deal a little bit unique based off of different circumstances and different places in which the market is currently operating within?
Yes. So the answer to that is each one is unique to the deal and to the appetite of the market. So you have to understand that the debt lenders, whether they're banks, agencies, or bridge, their appetite changes depending on the times of the market, depending on the interest rate. So if I said we're always going to use this type of a loan, I couldn't say that, because if the market changes, then that might not work. It might be a different loan structure. So the answer is it depends on the market and on the deal.
Okay, Danny. Well, hey, we're going to turn the page. We've got a portion of the show we like to call our Moonlight Coaching Round. And typically what we do is ask our guests a few questions. If you could hold your response to between 1 and 2 minutes, that'd be great. The first question I have for you is, what do you think every new real estate investor should know before investing in real estate syndications?
Well, there's more than one thing they should know, but they should know property management. They should know how to structure deals, the financing piece, and they should know how to raise their money. Because it's so much, probably the best thing to do is learn to partner with somebody that can teach you all of that.
Yeah, I say that's wise. You can watch firsthand and see exactly what it looks like from a person that's done that same task multiple times, rather than trying to wing it and potentially find yourself in a really bad place. So great suggestion. Next question. Knowing what you know now, what kind of advice would you give a person attempting to get where you are within their real estate journey about balancing business and life?
Well, regarding business and the real estate model that we use, I would say if you want to get in, learn how to raise money. If you can learn how to raise money, you'll always find a spot and someone to partner with. And then you can learn how to operate after that. If you're new and you want to try to tackle the whole thing all at once, I think it's too big of a bite.
Okay, how about the work-life balance? How do you view that? If someone was newer and they were just getting started, what would you recommend for them?
What's that work-life balance? You got to give something up.
Something's got to give, at least initially.
This business is not a 9-to-5 job. If you want a 9-to-5 job, then stay in a 9-to-5 job. You're going to be working late. You're going to be working long hours, especially in the beginning. Now, you can stabilize yourself and hire people to help you so you don't have to do that. But definitely in the beginning, it's an 80-hour work week, no matter what, however you spin it. You have to put your time in.
Yeah, I think that's an honest assessment. A lot of times that doesn't quite get mentioned, but I've been in this space for a couple of years, going into 3, and I just work. I put tons of hours into this, and in order to get any kind of traction, that's what it's going to take in order to get business off the ground in general. So, yeah, great response. The next question, if a person had minimal amounts of time, no money or experience, but they wanted to start a business like yours, what steps would you recommend for them to take to start and scale a business?
Okay, you said no money, and no experience?
Yeah, and minimal amounts of time, all 3.
Oh, wow. That's a hard question. If you don't have money, you don't have experience, and you don't have time, don't quit your job. Probably the best thing to do. Just don't get into it, because you can get away with no money. Maybe you can get away with no experience, but you got to put the time in. And that can come through sweat equity. That can come through something. Make yourself valuable for somebody that you can partner with. If you don't have the time, you know what? Oh, you're missing those 3 things. I don't know if I have a solution. It takes work. You got to pay your dues.
Yeah. Yeah, I agree with you. Something's going to have to give one way or the other. Either you are flush with cash, or either you have a lot of time on your hand, but you're going to have to bring something to the table in order to get your foot in the door at some point in time. So I think that's really great advice. The last question is, what are the best reasons to invest in real estate as a passive investor?
Oh, wow. Okay. So the 2 biggest ones that jump at me is it's real estate generally, not always, and there's no guarantees, can provide you a higher return than the stock market can. So you can put your money in there. It can grow faster. Plus, if you're able to utilize the tax benefits, and those are depreciation and cost segment funds. Some people can use them, some people can't, but you can utilize that on your tax returns and able to reduce your tax liabilities. Those are the two big ones that jump at me. Plus, you can keep your 9 to 5 job. If you're making a lot of money, you can invest it in real estate. So your money's working for you, helping you build wealth while you're still earning your money in your regular profession.
Okay. Yeah, great answers to each one of those questions. We're going to wrap things up, Danny. But before we do, we always like to ask our guests for a recommendation on personal development books or a business book. Do you have any recommendation?
Yes, one of my favorites is by Dan Martell, Buy Back Your Time, specifically for business owners. As we start a business, we like to wear all the hats, do all the work. Nobody can do it as well as we can. We got to be able to step away from that. We have to be able to learn how to delegate. We have to try to hire people, train them, take the time to train them, and start peeling the layers off of ourselves. That way we don't do the smaller task and we can concentrate on growing the business and more working on the business than in the business.
Mm-hmm. Yeah, Michael Gerber, he was an absolute game changer for me to be able to see him unpack that in such basic language to show the franchise model in which you're able to step away from the business and have the business run without you. So yeah, that's a great suggestion. I'll have to take a look at that. Buy back your time. Danny, we appreciate you coming on the show. You have provided some significant value, sharing everything from your humble beginnings as a lowly carpenter, all the way up into where you are now, full cycle on deals, doing really large apartment complexes. So you've made some significant waves. If someone wanted to reach out and connect with you, what is the preferred method?
They can reach me through our website, www.primecapi.com. Once again, primecapi.com. And you can look me up on LinkedIn under Danny Flores. You can find me there. Feel free to reach out. I'd be happy to help.
Okay. Well, Danny, once again, thanks for coming on to the show. We enjoyed you today, and we'd love to have you back anytime.
Thanks so much, Eric. Thanks so much for letting me be here.